As companies grow, management often needs to make decisions between different investment options. They may identify a need to build a new production facility, or perhaps some managers think that the current production facilities are sufficient, but they need to build more warehouses to improve the logistics of delivery. When managers consider these decisions, they aren't only deciding on how to spend current sources of funds, but rather also need to consider what these investments mean for future cash flows. Cash flow is an accounting of when cash is received and expended by a business. Part of these decisions should include financial analyses that measure or forecast an estimated return on investment, or ROI, for the project. This is typically considered by calculating the internal rate of return, or IRR, net present value, or NPV, and/or the payback period. All of these metrics provide management with important bits of information regarding the potential gains from an investment. For the purposes of this lesson, we'll assume those decision factors were favorable enough that management decided to lease a new production facility. Projecting the cash flow of an investment requires calculating all the costs and revenue that'll be associated with the new investment. In this example, that will be easy to do, since we'll be making up information. In real life, this part of the process can be very complex, since leasing a new facility can be expensive and it comes with many other costs. Also, anytime you try to anticipate revenue associated with a single location or facility, the forecasts can be flawed. If cash flow projections, either costs or income, are off, the entire analysis could be misleading. In this example, management has requested we forecast a 20-year cash flow statement. Let's start by estimating our recurring fixed costs, those that won't change no matter what level of production we have, along with any annual inflationary increases. Annual lease payment, no annual increase, equals $875,000. Annual utilities, 3% annual increase, equals $57,000. Equipment maintenance, once every 5 years, equals $45,000. Now, let's figure out our one-time fixed costs, those that we'll only have to pay when we move into the building. Production equipment equals $175,000. Repurposing space for production and office space equals $85,000. Finally, we can look at our variable costs, which primarily will be labor and materials. For each 1,000 units made per year, our labor increases by one person, or about $45,000 per year, and our materials increase by $30,000 per year, or $30 in materials per unit. For this analysis, management expects a demand of 360,000 units per year. After looking at the timing of those costs, the outgoing cash flow of our investment over the next 20 years should include $260,000 in one-time setup costs, $175,000 for equipment, and $85,000 for setup, $875,000 in annual lease payments, no annual increase, $57,000 in annual utilities with a 3% annual increase, $45,000 for equipment maintenance once every 5 years, $16,200,000 in labor costs, $10,800,000 in material costs. In a table format, by calculating the annual increases and occasional costs, our cash flow cost forecast would look like the table on your screen now. Revenue is easier to calculate. We know management is anticipating 360,000 units per year, so we just need to get the price of our goods, consider any increase, and forecast the revenue out 20 years. The current market price of our product is $69, and those prices have increased an average of 5% per year. We only anticipate those price increases will last another 10 years, at which point the price will stabilize. We can add a couple columns to our chart to reflect the revenue. To make the chart easier to read, all of the individual components of the cost have been removed and only the total cost is included. After looking at the chart, what should we report to management about this project? Of course, that depends on what they ask, and while this chart and cash flow analysis shows positive cash flow starting in year 4, we don't know what other options are available. This looks like a very favorable project, but until we do the same thing for other investment options, we don't know which investment is best. Like so many other financial decisions, an investment in a new project is typically an exercise in competing options. Thus, the results of a single analysis of a single project should be considered in the context of all projects. However, there are a few things we can say about our cash flow statement for the investment in a new, leased plant. First, we start out requiring an upfront $260,000 cash investment. Then, we're going to lose money for the first 3 years, and it will total almost $5.5 million. However, we more than make up for that loss in years 4 through 6. After that, we have some nice returns on our investment. Finally, we should note a couple things to management. First, our analysis is done in future dollars, meaning they aren't adjusted for inflation. Second, a net present value analysis of these cash flows would make our analysis more accurate by giving us an idea of what this project is worth in today's dollars. Assessing and estimating the cost and profitability of a capital investment is a critical step in managing cash flows, which are accountings of when cash is received and expended by a business. These analyses can shed light on what investments are most profitable and which have excessive risk or longer payback periods. It's important to remember, however, that without additional analysis, a cash flow projection will be in future dollars, which aren't adjusted for inflation. A net present value analysis will convert those costs and revenues into current dollars. When viewed in the context of other investment options, a cash flow analysis can be a significant factor in management decision-making.